Hi, I'm Jimmy. In this video, we're trying to answer the question, do we invest now or wait for the stock market to crash even more? The way we're going to try to answer that question is we're going to look at different economic indicators to see how strong the economy really is right now. But before we jump into that, I just want to tell you real quick about an investing platform that we're building. So we've got our private investing community hosted over on Discord. On Discord, we got a whole bunch of different investing channels where we all talk, share ideas, do some research projects together, and ultimately try to get better as a community at investing. We also do a couple investing live streams, private investing live streams every week. Some we do a valuation live stream, we do a portfolio live stream where we talk about my portfolio, we build the different portfolios. Plus, we do a research live stream where we try to analyze companies together and go through the process together so we could all get better at it. Okay, now let me tell you about the website that we're building. So we already built the beta version of our discounted cash flow calculator. And the idea is that we would have a website that has a bunch of different valuation methods. So it could be, how do you value banks? How do you value a large cap company? How do you value a real estate company? How do you value a company with no growth or negative free cash flow or negative profits? There's different ways to value all different types of companies. So that's where the website's trying to go. For now, we've already got the beta version of the DCF calculator up there. We're just going to keep adding from there. Now, if you'd like to sign up to get access to our investing community as well as the website, I will leave a link in the description below. Okay, now let's jump over to a very important economic indicator, especially in today's market, and that is inflation. So this is the inflation rate going back to the 1970s, and we can see that right now it's up quite high. In fact, if we zoom in a little bit, we can see that, yes, it peaked out at about 9%, and sure, we've had a few good months where it has trended lower, but as we saw on the longer term chart, overall, it's actually still quite high. Now, we don't want to look at this number in isolation. This is, by the way, the average increase in the price of goods and services. But what about wages? What about income? Well, for that, we can look at a wage chart and we can try to determine how that stacks up compared to inflation. Wages, as we can see again, going back about the past decade or so, wages have also jumped recently. And when we zoom in on the most recent wage chart increase, it looks very similar to inflation, except it's not as high. In fact, if we were to combine these two charts, well, we can see that while generally wage growth is slightly above the inflation rate, right now, in this whole time period here, inflation is it's fairly well above the average wage growth rate. And this is very, very important because if prices of goods and services are going up and wages are not keeping up, well, that's going to be a problem for the bigger economy in general. Spending is going to have to slow. So let's jump over to our economic scorecard. And when we get there, well, we can see that inflation is clearly a negative point. So the bears are going to get a point for the inflation rate. Wages are good. So we're giving that a bullish point. You're getting a positive sign there. But because wages growth is not keeping up with inflation, I don't think it's fair to weight them equally. I actually think it makes more sense to give a few extra bearish points to the inflation rate. So that I think is a more logical way to look at the current scorecard. For now, let's jump over to jobs. So this is a chart of the U3 unemployment rate going back about 20 or so years. Now, I know that there's a lot of criticism about the U3 unemployment rate because ultimately it can make the numbers look artificially low. It only includes people that are actively seeking work, but have been able to find a job. If you stop looking for work, they exclude you. There's another number called the U6 unemployment rate that some could say is better, but this is the most popular one, which is why I went with this chart. And I actually did a video on unemployment. I'll leave a link in the description below if you're curious. But basically, if you look at the shape of the U3 unemployment rate, compare that to the U6 unemployment rate, they're virtually the same, except the U6 one is higher. What we care more about from a data perspective is it is on the low end of history. We can see that right now, the number is relatively low compared to history, and this is a positive sign. Now, if we don't stop at unemployment, but we also look at some debt numbers, well, this chart, although it still is red like the other one, this chart is household debt relative to GDP. So 100 is 100% of GDP. And we can see that back in the peak of the financial crisis, back in 2008, 2009, in that time period, well, household debt was almost the same size as GDP, which is kind of crazy when you think about it. Now, since then, it has fallen a decent amount, which is logical. There was a spike when COVID first happened, but probably largely thanks to government stimulus and things like that. That number has continued to decline, and overall, we have been declining, and this is a pretty good thing. It's a pretty good sign for the broader economy. If we don't stop there and we look at another measure of debt, well, another thing to look at is how late are people on their credit card payments. So this is what percentage of active credit cards accounts are 90 days or more late on those credit card payments. And again, overall, the number seems to be declining a decent amount. And when we jump over to the economic scorecard, well, we can see that both jobs and debt get a bullish point. Both of those are positive signs for the broader economy. But now we're going to run into some problems because up next we have consumer confidence. And I actually think that consumer confidence is one of the most important economic indicators out there. So the way we can read this economic indicator, basically the higher the better. And we can see right now it's actually kind of low. The number is much lower. It's lower than it was, but it's almost as low as it was. It's right in the area that it was back in the financial crisis. Now, the financial crisis, I just want to remind everybody, the stock market tumble in the financial crisis, it fell just short of 50%. It was somewhere in the 40% area, 40 to 50%, how much the stock market fell. That was the worst stock market pullback since the Great Depression. Consumer confidence is right now sitting down at that same level. So that it's kind of a very big level. Now, this is so important from an economic standpoint because the US consumer is one of the biggest drivers of the entire economy. We're not as much of a manufacturing economy as we used to be. We are much more consumer driven now. So if the consumers are afraid to spend, if the consumers start pulling back, that can be a real problem for the broader economy. So when we jump over to the economic scorecard, well, clearly this is a point for the bears because this is a negative sign. Now, I could even make the case that this deserves extra weighting because it is that important of an economic indicator, but I don't want to get too biased yet. So for now, let's just jump over and look at housing. So this is a chart of housing starts going back to 2002. And basically what housing starts are how many new houses are getting built. And broadly speaking, the trend in recent years has been higher, which is good. But there's been a pretty drastic pullback in the past few months of housing starts. And this is actually quite logical because interest rates have gone up. And yes, there's a lag to when they increase interest rates and it affects let's say it affects the real estate market. But after that lag happened, it looked like there was some decent amount of pressure on the number of new houses being built. It also is going to impact housing prices. Not many people buying it, less people driving up the prices. So now for that, we can look at the price of existing home sales. This is put out by the National Association of Realtors. And we could see that first in 2020 and coming out of the dropping of interest rates at that time and then the stimulus packages that were done, housing prices went real high, real fast, excessively high. In fact, you could see, again, going back the past 20 years, you could see how much that ramped up. But then the pullback recently has been fairly large. There's been a decent sized pullback in the price of existing home sales. So clearly, I think that this is a negative sign for the economy in general because it's likely that interest rates will keep going up at least somewhat, but also the interest rate hikes that have already happened are likely to still be pushing through to affect the broader economy. Again, there's a lag to that. So when we jump over to the economic scorecard, well, clearly this is going to be a point for the bears because I think that the pressure is likely to remain on the housing market. And that's a big piece of the broader economy that could struggle for a little bit of time after, sure, some excessive runs for a while, but still, it's a negative sign right now. Okay, now let's jump over to the manufacturing sector to see how that looks. So this is the ISM Manufacturing Economic Indicator. And the most important level here is 50. Anything above the level of 50 implies positive growth in the manufacturing sector. Anything below the level of 50 is negative growth. So clearly anything below 50 is a bad thing for the manufacturing part of the economy. We just dropped below 50. So clearly, when we jump over to our economic scorecard, this has to be a point for the bears because this is a problem for the broader economy. Okay, now let's look at the interest rate yield curve. So this is the Treasury yield curve for US Treasuries. So this is the Treasury yield curve as of October of 2022. And the most important part for us to pay attention to with the yield curve is the shape of the yield curve. Normally, you want it upward sloping. Short-term rates should have a lower interest rate than long-term rates. We can see the problem here is that short-term rates are above longer-term rates. In fact, when we look at this chart, we can see that if we invested for 2 years versus 10 years, well, the Treasury would pay us more, a higher interest rate, to invest for a less period of time. This is generally a bad sign for the broader economy. Now, if we keep that arrow there and we fast forward to the way rates are today, well, we can see that rates have gotten even worse. In fact, now the 3-month Treasury yield is higher than the 10-year Treasury yield, which is kind of crazy if you think about it. That means that the 3-month yield, they will pay us more to invest for 3 months, a higher interest rate than they will pay if we invest for 10 years. Now, I should point out, these interest rates are annual interest rates. Interest rates are always annual. So you don't actually get 4.3% for 3 months. You get a quarter of 4.3% since you're investing for 1 quarter. And the 3.5% that you're getting for the 10-year one is 3.5% every year. 4.3, if you kept reinvesting in that over and over, you get 4.3% per year. Just wanted to clarify that. Now, if we go back to the 2-year versus the 10-year, and that's, by the way, one of the most popular Treasury yield spreads to look at, well, this is steeper than it was just back in October. So clearly, when we jump over to the economic scorecard, I think it's fairly obvious that this is going to be a point for the bears. And it's probably important enough from a scorecard perspective that this one probably should deserve 2 points, since, again, this is the yield curve has, an inverted yield curve has preceded every major recession for like the past 100 and some odd years. So clearly it does a good job of forecasting problems to come. Okay, now this brings us to the question, do we invest now or wait for the stock market to go down even more? And I think that there's 2 very logical answers here. First is dollar cost averaging, people investing for the retirement, things like that. The economy in general shouldn't really affect your overall investment strategy if you're dollar cost averaging. That should always be stuck with. From a invest now or wait perspective for the individual investor who's trying to pick stocks, well, I think that there are so many good opportunities out there right now. If we can invest strategically where we are finding good opportunities, ideally undervalued opportunities that we would want to hold for many years, well, in time, the stock market will recover, the economy will recover, and once again, we'll be bumping up against all-time highs. And if we buy the stocks when the stock market is down like this, well, that's really going to make our investment portfolio do very well for us in the long run. That brings us back to the discounted cash flow calculator and investing platform we're building. So if you'd like to sign up to get access to that, like I said before, I will leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.